Hey, what's going on? This is Leo. So today we're going to talk about how to potentially gauge how long the squeeze could last by uh, the angle of previous trends and potential prices that it could go to. So taking a look here at the very first move, right, starting in January of 2021 to the high January 28th, you'll notice that I've drawn a line connecting the low and the high. So obviously there is a slope, there's an angle to that trend. So if we just move this forward, what you'll notice is that the move in June took roughly the same amount of angled increase. The angle, the pitch was just about the same. It's not exactly the same. Obviously, it took a little bit longer. So it was a little bit more sloped down. But what this gives us is an idea as to how long a squeeze would take going forward. So just assuming that we're going to go from here, right? And I don't know whether we are, but if we're going to, we can extend that out into the future, right? So now we have our slope, assuming this is the velocity as to how quickly the squeeze would run up. Now, also keeping in mind, this doesn't take market halts into consideration, so that's kind of an unknown factor here. But starting from the low in January, once again, we're going to measure out. So going forward, you can see that that took 21 days, 22 days, somewhere around there. So just assuming we're going to start from here and not from here, because the low in February was a lot of sideways chopping around. So I want to start from where the parabolic move starts. So we're going to start from this point in May going to the June high. And you'll notice that that took about 26 days to play out. So going forward, right? Now, this is just going to be posting up $1,000 target. I'm not saying that's the peak, and I'm not saying that that's only how high it can go. It's just an arbitrary number that I'm putting out there to measure how long it could potentially take. So starting from the low that we put in around 1340 or wherever it was a couple weeks ago, going forward in time, you'll notice that if price keeps the same rate of increase, if it keeps that same angle that it did in the previous two run-ups, then we can assume that it would hit $1,000 right around the 46th day. So it'll take a little bit of time for it to run up, assuming that we're going to, it's going to be the same type of run-up before. If you recall a few videos back, I had made the point that markets can move very quickly, and in my own personal day trading, I've had situations where I go to the bathroom or go to the kitchen to get something to eat, and I come back and I miss the trade that I was waiting for all morning. So I'm not saying that the entire squeeze is going to play out in that amount of time. I had somebody make that comment. I'm like, that's not what I'm saying at all. What I'm saying is that, let's say, for example, this is just an example. I'm not saying this is the peak, but let's say you're targeting, excuse me, allergies are really bothering me this morning. Let's say you're targeting 1,000, right? And let's just say, for argument's sake, that would be the peak of the squeeze. Well, a wick, right? It could be sitting here at, let's say, 650, right? 660, and you're waiting for that. A wick could happen that quickly. It could spike really quickly to 1,000 and then come back down and trade around 600 to 800, right? And so now that what happens is you're sitting there and you're waiting for it to go back up to 1,000, but you're sitting and you're holding. Well, it'll come back and it just kind of starts drifting down, and you're still waiting. So that was kind of my point, is that a wick can happen very, very quickly. So I wasn't saying that the entire squeeze would play out in the time that you go to the bathroom. Let's see what else. So now if we move over to the Bollinger Bands, for those of y'all that are unfamiliar with Bollinger Bands, they are a way to gauge volatility in the market. And so what you'll notice is before, in the January run-up, we saw this really tight contraction within the Bollinger Bands, and then they expanded out. And then the same thing happened before June. You saw the contraction, the decrease in volatility, and then you had this massive explosion of volatility as it increased. We even saw it here to a certain degree. This is you can see the Bollinger Bands squeezing in, and then they begin to expand out again. So what it does is it kind of gives you a way to gauge when a very strong move, a break in volatility could be happening. So moving into here to where we are, we're seeing the Bollinger Bands starting to contract. They obviously haven't contracted to the degree that we're seeing here, but they certainly are closing in with this reduced volatility that we're seeing. So what I would be looking for as a sign that the squeeze is actually starting is I would see a break above the first deviation of the Bollinger Band here, the yellow one. So for example, if today we just shot up and we were at $36, then in my mind, okay, the squeeze is starting, right? Because now we're seeing a massive increase in volatility, and I would expect it to continue that much higher. Now, what I plan on doing with my runner, because I've gone over my brackets and whatnot, I've said that I'm going to keep a portion of it to let it run, and I'm going to be trailing it and monitoring it. So for me personally, I'm not telling y'all to do this because I'm not a financial advisor. I can't do that. But what I will be doing is that if I see, right, so here, let me zoom in here a little bit. Damn it, hang on one second. Oh, really? I'm going to call that good enough. So, right, so here, back in June, we see the break of the Bollinger Bands. Volatility is expanding. The squeeze in June is starting, right? Price is running up. So in order for price to stay within the blue and red deviations of the Bollinger Bands here, it would need to maintain its velocity. It would need to maintain the rate at which price is increasing. If that stops, what that means is that we're seeing a decrease in the momentum in the market. So if, for example, we come up to fill in the blank price, right? And then I see us trading sideways, and I see the market pulling back to a degree that it's falling back within past the first deviation, the yellow Bollinger Band, right? I'm going to be looking to get out then, because to me, if it's already up well beyond the target that I had in mind, and it's at a point where I'm very happy with the trade, but more importantly is that would look like it's losing its momentum, right? So what I would do is I would pull up a Fibonacci retracement from the high coming down to the low that it broke with the yellow deviation. And then I would just, as soon as we get the pullback, I'd be looking to sell at or close out the position at that 618. Now, there's a, I don't want to say not necessarily a caveat, but I do want to bring this up, right? You can have a trend where price breaks the standard deviation, right? It moves beyond in the Bollinger Bands, right? So you get the squeeze and then it pull back and go lower, pull back and then slowly drift down. But typically you see this with a more gradual trend. So if you look here, you can obviously see the difference, right? In this parabolic straight run up, right? Versus the move we were just looking at where it's this gradual grind down. So the price doesn't have the speed, the rate of price increase required to stay within that outer Bollinger Band. So that's why it doesn't work on gradual moves, but it works very well when you're dealing with these parabolic moves where it just shoots straight up. Because once that momentum is gone, that's when you pull out of the third deviation. You start pulling back, right? Because that the equity, the security is losing its momentum at that point. So hopefully that makes sense. And that's also me explaining why it doesn't work very well with the gradual trends. But that is pretty much it for this video. I think that pretty much wraps it up. If you found this content valuable, please like and subscribe, and I'll talk to y'all later.